Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cabot Corporation quarterly report. Cabot Corporation offers a diverse range of businesses and services across two primary segments: reinforcement materials and performance chemicals. The company's product portfolio includes reinforcing carbons used in tires and industrial products such as hoses, belts, and molded goods. Additionally, it provides engineered elastomer composite solutions. In the performance chemicals segment, Cabot offers specialty carbons for various applications including inks, coatings, plastics, adhesives, toners, batteries, and displays. The company also produces conductive additives and fumed alumina used in lead-acid and lithium-ion batteries for electric vehicles. Furthermore, it provides fumed silica used in a wide range of products such as adhesives, sealants, cosmetics, batteries, inks, toners, silicone elastomers, coatings, polishing slurries, and pharmaceuticals. Other notable offerings from Cabot Corporation include aerogel, which is used for thermal insulation and specialty chemical applications. The company also provides masterbatch and conductive compound products for various industries such as automotive, industrial, packaging, infrastructure, agriculture, consumer products, and electronics. Moreover, it offers inkjet colorants for inkjet printing applications and carbon nanotubes and fumed metal oxides. Overall, Cabot Corporation's product portfolio is extensive and diverse, catering to a wide range of industries and applications. The stock price of Cabot Corporation has experienced a substantial drop of over 12.08% in the past year, with a notable decline of -19.16% observed between February 2025 and February 2026. The primary cause of this decline was the company's first quarter fiscal year 2026 earnings report, which revealed several key factors that negatively impacted its stock. One major factor contributing to the decline was Cabot's missed revenue and decreased sales. The company reported consolidated net sales of $849 million, missing analysts' consensus estimates by a significant margin. This was accompanied by a 13% decrease in adjusted earnings per share, EPS, compared to the prior year. Furthermore, the reinforcement materials segment experienced a 22% decline in earnings before interest and taxes, EBIT, primarily due to reduced tire customer production and inventory management. The company's cautious outlook for fiscal year 2026 also contributed to the negative sentiment in the market. Cabot narrowed its adjusted EPS guidance to a range of $6 to $6.50 per share, which was below analyst consensus estimates. This conservative forecast reflected expectations of continued challenging market conditions, particularly concerning regional demand trends in reinforcement materials due to increased Asian tire imports into Western regions. While the earnings report highlighted some positive aspects, such as growth in the battery materials product line and a new supply agreement, these were overshadowed by the overall decline in revenue, EPS, and future outlook. As a result, investors reacted negatively to the news, leading to a significant drop in Cabot's stock price. Cabot Corporation maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Cabot Corporation trades at a lower price-to-earnings ratio of 13 times and a higher price-to-book ratio of 2.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 2.37%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an analysis of various factors affecting net sales and operating revenue. A significant decrease in revenue is attributed to less favorable pricing and product mix, resulting in a loss of $61 million. Additionally, lower volumes in the reinforcement materials and performance chemicals segments have contributed to a decline in revenue by $56 million. On the other hand, there are instances where revenue has increased. The reinforcement materials segment saw an increase in revenue from $1,156 million in fiscal 2025 to $1,234 million in fiscal 2026. Furthermore, the performance chemicals segment experienced a 2.9% increase in revenue, amounting to $9 million. However, it is essential to note that some segments have witnessed a decline in revenue. The materials segment saw an 11% decrease from $611 million to $520 million, while the reinforcement segment experienced a 15% drop from $1,822 billion to $1,731 billion. These declines can be attributed to less favorable pricing and product mix, as well as lower volumes. In conclusion, the primary drivers of revenue growth or decline are largely influenced by factors such as pricing, product mix, and volume. While some segments have experienced an increase in revenue, others have seen a significant decrease due to these factors. The net income of the company experienced a significant fluctuation over the period. Initially, it increased by 26% from $82 million to $104 million on page 3. However, this trend was short-lived, as it decreased by $22 million on page 5 and further declined by 21% from $104 million to $82 million on page 9. The net income continued to decrease, dropping by 20% from $93 million to $73 million on both pages 21 and 41. The profit margins also underwent changes during this period. On page 3, the gross profit margin decreased from 25.1% to 23.8%, while the operating profit margin increased from 15.2% to 16.3%. However, this increase was contradicted by other pages, which implied a decrease in profit margins due to the decline in net income on page 5. The net income margin also decreased from 9.7% to 10.9% on page 3. The reasons for these changes were varied and complex. Restructuring charges were cited as one of the factors contributing to the decline in net income on page 22. Lower earnings, particularly in the reinforcement materials segment, were another reason for the decrease in net income on pages 39 and 41. In contrast, the performance chemicals segment experienced an increase in EBIT on page 41. Overall, these changes highlight the challenges faced by the company in maintaining a stable financial performance over time. The company is experiencing a positive trend in its operating cash flow, indicating a strong financial health. The data from Cone 2026 and Cone 2025 shows that the company generated $126 million and $124 million, respectively, in cash provided by operating activities. This suggests that the company's core business operations are generating sufficient funds to support its growth. Furthermore, the net income adjusted for non-cash items also reflects a positive picture, with $126 million recorded in Cone 2026. This indicates that the company is not only generating revenue, but also managing its expenses effectively, resulting in a significant amount of cash being available for reinvestment or distribution to shareholders. Overall, these figures suggest that the company is on a solid financial footing and capable of sustaining its growth trajectory. The company's debt level and interest expenses have undergone significant changes. On one hand, the long-term debt has decreased by $2 million, while total current liabilities have also seen a substantial reduction of $83 million. However, borrowings under the Euro credit agreement increased from $128 million to $130 million. Additionally, there was a decrease in debt level of $26 million from September 30, 2025 to December 31, 2025. In terms of interest expenses, net interest expenses have decreased significantly from $30 million to $11 million. This reduction can be attributed to an increase in interest income from $6 million to $7 million. Furthermore, interest expense remained constant at $18 million for both years, indicating a stable trend. Overall, the company's debt level and interest expenses have shown notable improvements, suggesting a more favorable financial position. Management's outlook for the company suggests a cautious approach to forecasting future results. They emphasize that interim periods are not indicative of full-year performance, implying that there may be fluctuations in revenue and expenses throughout the year. In terms of specific financial projections, management expects the operating tax rate to range between 27% and 29% for fiscal 2026. This suggests a relatively stable tax environment, which could have a positive impact on profitability. The company is also investing in capital expenditures, with plans to spend between $200 million and $230 million on sustaining, compliance, and improvement projects at operating facilities. This investment should help maintain and improve the company's operations, but may also increase expenses in the short term. Management is confident in the company's liquidity position, stating that it has sufficient funds to meet operational and capital needs for the next 12 months and foreseeable future. However, they are evaluating the impact of new accounting standards on the company's financial statements, which could potentially affect profitability or cash flow. Finally, the company will be ceasing production of fumed silica at its Barry, Wales plant starting in the fourth quarter of fiscal 2026. This decision may have implications for revenue and expenses, but management has not provided further details on the reasons behind this move. The company has made significant moves through acquisitions and divestitures over the years. In terms of acquisitions, one notable deal was the purchase of safety respiratory products business from American Optical Corporation in April 1990. This acquisition marked a strategic move to expand the company's offerings. On the other hand, the company has also engaged in divestitures to streamline its operations and focus on core businesses. A notable example is the disposal of its respirator business in July 1995. The company has a history of distributing value to its shareholders through both dividend payments and share buybacks. Over the past few years, the company has consistently paid dividends, with amounts ranging from $13 million to $24 million annually since 2022. In addition to these regular payouts, the company has also declared dividends for 2025 and 2024, totaling $48 million. Furthermore, in fiscal 2026, the company took a more aggressive approach by buying back shares worth $52 million. This move demonstrates the company's commitment to returning value to its shareholders, while also maintaining flexibility in its capital allocation strategy. There are concerns about inventory buildup or supply chain disruption. The data suggests that there is a potential issue with inventory levels. On page 6, it is noted that finished goods inventory increased by 6, indicating a possible accumulation of stock. This increase in inventory can be attributed to several factors. Firstly, lower production levels at tire customers, page 35, have resulted in a reduced demand for reinforcement materials. Secondly, year-end inventory management practices by customers in the Americas have also contributed to this issue. Furthermore, weaker demand in Europe has also played a role. The impact of these factors is evident in the reinforcement materials segment, where lower volumes are being reported, page 46. This disruption in supply chain operations can have significant consequences for businesses and industries involved. That concludes the financial summary for Cabot Corporation. Feel free to comment below, and I will be happy to answer them when possible.